Welcome to the deep dive. Today, we're digging into a really interesting story, Intel Corporation, that's INTC. They just had this, frankly, stunning Q3 2025 earnings report. First profit, right? After 6 straight quarters of losses, stock rallied hard on that news.
It really did. More than just numbers, it felt like a bit of, psychological validation for this huge turnaround they've been attempting for years. So our mission today really is to unpack the source materials we have. We want to look at these sort of key conflicting points. You've got the Q3 rebound, sure, but then this wild difference in how people are valuing the stock. And then there's the ambition of their foundry strategy versus the very real operational hurdles they're facing.
Absolutely. And just for context upfront, INTC market cap hovering around, what, $170 billion?
Yeah.
Let's close near $38.88. It's a complex turnaround. So really important reminder here. This deep dive is strictly informational, educational. Okay, we're just discussing the materials provided. Definitely not financial advice. Always do your own research before making any investment calls.
Exactly. Critical point. We're aiming for insight from the data, not recommendations.
Okay, so let's jump into that Q3 win. Section 1. The earnings triumph. The numbers looked undeniably good. Revenue hit $13.7 billion, that's up 3% year over year, and non-GAAP EPS, $0.23, both significantly better than they guided for.
Right. And what's key here, I think, is that this makes it 4 quarters in a row where they've shown operational improvement. That kind of consistency is vital if they want to rebuild investor trust,
Yeah.
But beyond the profit itself, the bigger story maybe behind that rally was the massive cash injection they secured. Really shored up the balance sheet.
Yeah, the sources mentioned something like $20 billion in cash secured. That's a huge vote of confidence, isn't it? Can you break down where that's conceptually coming from, not just the numbers, but the sort of pillars behind it?
Sure. So that $20 billion war chest, think of it like this. 3 main sources. First, there's significant government backing. We're talking $5.7 billion from the U.S. government, recognizing Intel's strategic importance, as a domestic chip maker. Second, strategic partners are stepping up. That includes an expected $5 billion from NVIDIA closing this quarter, plus $2 billion already from SoftBank. And third, they're generating cash internally through strategic moves, like closing the Altera deal. All this gives them breathing room.
And that cash is already translating to positive flow, right? Sources show $2.55 billion operating cash flow and adjusted free cash flow positive at $900 million in Q3. Looks like they're getting healthier.
They are, financially speaking, in the short term. But this immediate success leads us straight into the next big question, Section 2. Valuation and those near-term headwinds. They've shown they can execute better? Yes. But if things look better, why is there this huge gap between, say, a fair value estimate and where the stock is actually trading?
Exactly my question. Our sources point to a fair value estimate. What analysts figure based on current and near-term profit around $22.97. But the market's got it near $38.77. Why the disconnect? Why trust the $38 price when the analysis suggests maybe $23?
Well, that disparity, that's kind of the definition of a speculative element in the stock right now. The market isn't just valuing Intel based on its current cash flow, like a typical semiconductor company. It seems to be valuing it as a strategic, almost geopolitical asset. It has immense government backing, plus this expected long-term demand from the whole AI boom. Investors are essentially pricing in the future success of that huge foundry pivot they're making.
Right, pricing in perfection, almost. But the near-term guidance they gave, that suggests maybe we should temper that optimism a bit. I noticed Q4 guidance looks like a pretty sharp step back from Q3.
Yeah, it does, yeah. Q4 revenue guidance is basically flat, $12.8 to $13.8 billion. And the non-GAAP EPS, it drops dramatically, down to just $0.08 from 23 cents in Q3. And remember, while that Q3 non-GAAP profit was a big psychological win, non-GAAP lets them exclude huge costs. Costs tied to restructuring, ramping up the foundry. Those costs are still there, hitting the bottom line, especially dragging on Q4.
And the margin decline expected in Q4 is also pretty stark.
It is.
Yeah.
Gross margins expected down to 36.5%. Now, this isn't necessarily failure. It's more like the cost of doing business for them right now. It's driven by shifts in what products they're selling, plus the naturally higher initial costs of ramping up new tech. Things like the Core Ultra 3 and the really critical Panther Lake chips on their new 18A node. Plus, you mentioned the founder earlier that business, their Future Hope, reported a, staggering $2.3 billion operating loss in Q3 alone.
Oof. Okay, that leads us right into Section 3 then. The ambitious turnaround and their whole AI strategy. Because that foundry pivot, that's the reason for the $38 price tag. You're saying Intel is trying to be the only U.S.-based player doing leading-edge chip R&D and manufacturing.
And that positioning is absolutely critical. It guarantees government interest, subsidies, the strategic angle. The long-term bet here is massive. The Foundry wants a big slice of that projected tenfold increase in AI capacity demand by 2030, and they're showing progress. The Intel 18A process, that's their key to competing with. Like TSMC, it's apparently on track. Panther Lake using 18A should hit the market this year, and Fab 52 down in Arizona is up and running.
Okay, manufacturing is one piece, but where do they fit into the whole AI leadership picture? NVIDIA seems to dominate that conversation.
They're leaning hard into the existing strength of the x86 ecosystem. That's their core. They argue x86 gives you compatibility, security, things that are foundational for hybrid AI, especially inference and edge computing, which are huge volume areas. But maybe the most strategic thing is actually collaborating with NVIDIA. They're working to integrate Intel's CPU strengths with NVIDIA's AI accelerators for new custom products, both data center and PC. Sort of a, if you can't beat them entirely, partner strategically approach.
Makes sense. And their main product groups seem to be trying to capitalize on current trends, too. Client computing group focusing on AI PCs, the Windows 11 refresh cycle everyone's expecting, and the data center side seeing strong demand for their new Granite Rapids, the Xeon 6 processors, so the roadmap sounds technically strong.
The roadmap looks good, yes. But how much does a great roadmap matter if your economic moat is only rated narrow? That brings us to Section 4, the constraints. Historically, Intel had this wide moat, right? Unbeatable. But fierce competition, mainly AMD and NVIDIA, plus their own past execution stumbles. Well, that's eroded their advantages. Right now, it feels like they're fighting for survival and relevance, not necessarily dominance.
And there's still that harsh operational reality check, too. It's not just competitors, it's actually making the chips, capacity issues.
Exactly. Supply chain bottlenecks are still a real problem. They're limiting how much demand they can meet, particularly constraints on the older Intel 10 and Intel 7 nodes. That actually held back Q3 fulfillment, and sources suggest this tightness, plus ongoing substrate shortages. Well, it could last into 2026. That's a serious threat to hitting those aggressive targets.
Wow. And that operational pressure must make the sheer amount of money they have to spend the CapEx feel terrifying. They have to invest massively, but somehow also show they're being careful with money.
It's a classic tightrope walk, isn't it? Total CapEx deployment is huge, expected over $27 billion in 2025. It's a bet-the-company level investment needed to catch up. But management is really trying to emphasize capital discipline now. They've basically committed to linking future spending directly to committed external demand for the Foundry. That's a crucial move to try and mitigate the financial risk, so they aren't just building empty factories based on hope.
Okay, finally, let's touch on Section 5, analyst sentiment and key metrics. This really highlights that divergence we talked about earlier. The price targets are all over the place.
They really are. It reflects the sort of binary nature of this bet, doesn't it? You see recent targets as low as $20. That reflects the sheer execution risk and the current weak fundamentals. But then you see targets as high as $43. That reflects belief in the whole strategic pivot, the government support, the AI angle paying off. The average target is sitting around $31.78 smack in the middle. It shows Wall Street just fundamentally disagrees on whether they can pull this off.
But looking further out, the consensus forecasts seem to buy into that long-term vision, right? Assuming they execute well.
Oh, absolutely. They were completely on that hockey stick kind of projection. Near-term revenue growth looks ugly, expected to stay negative through 2026. But then, boom, by 2028, revenue growth is forecast to jump to nearly 19%.
And the earnings per share forecast is even more dramatic. Really shows the potential payoff from the Foundry if it works.
It's the projected turning point, exactly.
Yeah.
EPS is forecast to get back into positive territory in 2026, around $0.22. Then it shows explosive growth in 2027, over 207% forecast, and another big jump, 54% in 2028. So the consensus is clearly betting that the 18A node and the AI market demand will pay off big time, but, several years down the road.
Okay, so what does this all mean? Wrapping it up. Intel feels like the absolute definition of a high-stakes, high-risk turnaround play. They've got this enormous cash pile, crucial government backing, a clear strategy targeting the massive AI market.
But, and it's a big but, they are operating under intense pressure, competitive and operational. There's huge execution risk. And today, the stock price looks stretched, based more on hope for the future than on current earnings. It's genuinely one of the most compelling gambles in the market right now.
Which sets up our final provocative thought really well. As if the operational risk wasn't enough, the source materials mention something subtle but potentially critical. There's an ongoing consultation with the SEC about how they account for government transactions.
Yeah, there's a detail not to overlook. It introduces a layer of Material financial uncertainty. There's even
Yeah.
potential for revisions to past results depending on how that consultation goes. So that regulatory uncertainty adds this unpredictable element on top of an already incredibly complex transformation. It's something you definitely need to keep an eye on as an investor, regardless of how well their new chips perform.
Well, thank you for joining us and digging into INTC on this deep dive. If you found this discussion useful, please do hit that subscribe button. Maybe tap the bell icon too. It really helps support the channel, and it ensures you won't miss our next custom knowledge deep dive. We'll see you next time.